Have the next in our series of member-led learnings. So these are where we harness the expertise that is within the membership and share it with other members. And this is part of our marketing booster package and one of the options. So if you have expertise that you want to share, then please do get in contact with myself, Kirsty or Claire Dumbleton, and we'll be very happy to talk you through what that looks like. But today we have Finance for Non-Finance Managers. We have Ross Aala, who is going to be leading today's learning for us. From Accountancy Learning, and we have a few of the Accountancy Learning team on the call as well, so hopefully they've also shared their contact details with you. Just a few bits from me so we can get started on the main bit. I'm hoping you do know about the Devon Business Show 2025. So we have only a few spaces left to exhibit. There are plenty of opportunities and ways in which to harness this event for marketing your brand, either by coming along on the day, joining us on the pre-show breakfast, booking a stand, or also the other marketing support that goes with it. But it is going to be a fantastic day. It's a really, really good opportunity to network with both a large number of businesses, but also the general public. So there's opportunities to maybe let people know that your business is looking for new talent, new clients, new partnerships, or just to be able to showcase what you do to Devon. So there's a QR code there if you want to know more, and we will share these slides with you afterwards, including Ross's. And then finally, again, I'm not going to dwell on this one, but it will be on the slides that come out, the upcoming events that we have for July. So July is another busy month. They are colour coordinated. So the teal ones mean that they are in Plymouth. The pink ones mean they are in Exeter. And the blue ones mean that they are around Devon or virtual. So I am now going to end my slideshow and stop sharing and hand back to Ross.
Thank you very much. Right, so hopefully my sharing is coming up. There we are. So welcome everybody. Thanks for coming along. Normally these sorts of sessions that I attend, the speaker seems to spend far too long talking about themselves, and I'm sure you're not really interested in me, are you? So I'm not going to do that. I'm Ross, and I'm an accountant, which normally would kill a conversation. But anyway, what I want to achieve today then is hopefully make your lives a little bit easier. So we sort of published in the introduction that we had these 3 objectives to help you with some terminology. And I don't know why, as accountants, we try to talk a different language. But I think all of us, in whatever profession we're in, we do that. I know lawyers are very good at talking in other languages, including Latin, just to make it hard for us to understand what they're talking about. And accountants do the same, because if you don't understand what we're talking about, that means we can charge you more for explaining it. But in the day-to-day world, that doesn't really help you very much, does it? When the accountants are talking about things and you don't really get what they're talking about, and a certain amount of bravery is required to say, I know you've used that word for the last 5 years, but I've never really understood. So can you explain it to me now, please? So hopefully I'll be able to help you with some of that. Sadly, I've only got an hour to go through this, and we could spend a whole day helping you with all the terminology and the jargon that accountants use. So there's only a limited amount I'll be able to deal with this. In the second thing then, accountants are very good at presenting numbers to people, but actually quite a lot of us don't really see what's going on below those numbers. So I want to help you out then by can we sort of understand the story behind the numbers? What do these numbers actually tell us about a business? And what we're going to do, we're going to have a look at a set of accounts. We're actually going to look at the chamber accounts again, the Devon and Plymouth Chamber, so it's sort of a previous iteration of the organisation. So all of companies' accounts are available for public to have a look at them on Companies House. So I just grabbed these accounts from Companies House, and yeah, we're going to have a look at these and see if we can sort of tell the story behind them. And if any of you wanted to book a course like this, then we could use your accounts to help you understand what's actually happening in your business. But anyway, so I'll be looking at those a little bit later. And then also, so I saw one of your email addresses is your pricing. So you contribute to the numbers in the accounts in some way, but how? So where does your element appear? So yeah, I'll be also trying to look at that as well. Yeah, so where do you fit into the accounts? Yeah, how does that work? And so we also do that when we look at the sort of the chamber accounts as well. Okay. Now, in terms of asking questions, please feel free to ask questions as we go along in the chat, or put your hand up to draw my attention, or just talk to me. Okay, that's fine as well. Don't wait until the end, because normally you've got another meeting to go to, so you won't have time to do that, or you will have just forgotten what you wanted to ask anyway. So yeah, just please feel free just to interrupt me as we go along, because I think that's just going to be a lot more easy for everybody if we're sort of dealing with issues as they come to your head. Okay. Right. So let's look at the terminology first of all. Again, as I said, there's loads of language that accountants use to effectively confuse everybody. So I've got too many slides here. So what I'm going to do, I'm just going to let you vote on these. I'm going to give you a list on each slide, and then you can choose which one you'd like me to explain. Okay, so at the moment then, I'm looking at conceptual terminology, and it's up to you which one you'd like to have a go at. So I'm just going to put a poll on the screen, and if you could just vote, please, which of these four things would you like me to explain to you today? Okay, so I can't see any more voting going on. Anyway, so accruals wins the vote with 36% of the vote. Okay, so let's look at accruals then. So there we go. So here's the simple explanation. Accruals are when we recognize transactions when the transaction happens. So what does that mean? Let's suppose we buy a car. Okay, now that car may last for 3, 4 years, 5 years. Okay. Now we buy that car, so we spend all the money up front buying that car. So the cash is spent today, but we're going to use the car for 5 years. So the accruals concept tells us that if we're going to use the car for 5 years, we should recognize the cost of the car over the 5 years as well. Because it's sort of, there's a bit of a disconnect if all the cash goes out on day one, but we use the car for 5 years. Okay, so if we're going to have the benefit of the car for 5 years, if the car is going to help us to earn money for 5 years, then we want to show the cost of running the car over the same period. So the income from the car is going to be shown in one place in the accounts, and the cost shown at the same time. Because if we had the income from the car for 5 years, but all the cost on day one, it wouldn't match. It would just look a bit odd, wouldn't it? It'd be a massive cost on day one, but income spread over 5 years. So that wouldn't really make a lot of sense for most people. Okay, so sometimes this accruals concept is also called the matching concept because we're trying to match cost with benefit. Okay. Let me give you another example to help us understand this. So you're all in your offices now, and you're using electricity to have the lights on, have your computer working. But when will you actually pay for that electricity? You may pay next month. Okay? So we're getting the benefit of the electricity today, but we actually pay for it in next month. Well, the accruals concept says if you're using the electricity today, you should show the cost today. Okay, we don't really care when you actually spend the money. Yeah, so we want to recognize the cost when the thing actually happens, when we get the benefit. Okay, so I'm guessing in lots of your accounting departments at the end of each month, they may ask you, we want to know about the accruals. So what they really want to know from you, have you done anything this month that we're going to pay for next month? Because they want to show the cost this month. Yeah, so you may have ordered something, the goods have arrived. Well, if you've got the goods in your warehouse, yeah, you may pay for them next month, but we should show the cost for them this month because you've got the goods. Okay, so that's the idea of the accruals concept. And it's one of the fundamental concepts in the accounts. Okay, we don't really care when the cash moves. Okay. Anybody want to ask any questions about that?
That's really clear. Thank you.
Right, let's go to the next batch then. So here's some more terminology in terms of the financial statements. So again, we've got profit and loss, balance sheet, budget, and forecast. So let's let you vote on this one. Oh, where's my poll gone? Oh, it's gone. See, I'm trying to be so organized, and this one has gone. Okay, well, let me briefly go through all of them then, if you can't vote. So the profit and loss, this has lots of different names actually. So yeah, here in England we tend to call it profit and loss, but in other countries they may call it an income statement. Okay, so it's basically showing all the income we're getting and all the expenses. And income minus the expenses, that will give us our profit. Okay. And I think it's useful for us to understand that profit isn't factual. Okay, lots of people think that the numbers in the accounts, they're all based on fact, but profit is not factual. We can sort of make it up. You know, we don't have complete freedom to make up profit, but, you know, we talked about accruals, didn't we? That we may have an expense this month, but we haven't got the invoice for it yet. We haven't paid for it yet. So we may need to estimate what the expense is. So yeah, we just need to be aware that revenue and expenses in our profit and loss account, they could be estimates. A lot of numbers in the accounts are estimates. Okay, but yeah, there's a misconception that you know the numbers in the accounts are all based on fact. There's some fact in there. Okay. And then what about balance sheet then? So the balance sheet, those are all the assets that we have. And we deduct all the liabilities. So the assets, you know, very simply, is the stuff we have. And the liabilities, that's where we owe to other people. And then equity is the difference. So people talk about things like negative equity with their houses. Okay, so what does that mean? That we've got a mortgage, that's what we owe, that's the liability. And we've got the house, that's our asset. And if the mortgage is bigger than the value of our house, that means we're in negative equity. So, you know, 16, 17 years ago, there was a banking crisis and some people's houses went down in value and some people's mortgages were bigger than the value of their houses. So they had that negative equity. Okay, and that applies for the businesses as well. If we take all of our assets and everything that we owe to everybody else, hopefully what we owe is smaller than all the stuff that we have. So we have positive equity, hopefully. And that equity is basically belongs to the owners. Okay, so if we wanted to close down the business, we'd sell off all the assets, pay off all the liabilities, and whatever we have left, we give back to the owners. So that's what the equity is. It's what we give back to the owners. Okay. And then for the last two, so the budget is basically our plan, and I guess many of you may be involved in preparing budgets. And I don't know whether you find it easy or not. Yeah, okay, let's do an instant poll for this one then. So if you have to participate in budgets, do you love doing budgets or do you hate doing budgets? Oh, okay. Well, blimey, I'm surprised. So most people, 63% of you have gone for you love doing budgets. I hate doing budgets because I can't see into the future. And then when I'm held responsible for meeting that budget, I think, well, that's a bit mean, isn't it? Because I couldn't see into the future. How could I guess this really? Um, so yeah, that's what a budget is. And then just in terms of how is a forecast different to that? So we may be asked about forecast as well. Well, a forecast is what we expect to happen, which I hate as well because I just cannot see into the future. So yeah, we may have an original budget, but then we try to update that. Yeah, the budget is the original plan, but then the forecast will be, well, what do we think will happen now based on what's been happening most recently? Yeah. So yeah, so how to do budgeting and how to do forecasting. Again, if you wanted to come onto our full course, we could explore that as well with you. But yeah, we don't have time. Gosh, I've only got 40 minutes left. Okay. Right, so let's think about some of the terminology within some of these statements now. So in the profit and loss, we've got some different words. You've got income, revenue, gains, and expenses. So yeah, let's decide which one of these would you like me to explain to you, please? Yeah, I'm guessing many of you may be thinking, well, the first three, aren't they all the same? Well, no. I'm hoping those of you who are joining on your phone that it's easy to press the buttons for these polls. Okay, thank you very much for that. Okay, so most of you have gone for gains as 44% of you. Okay, so yeah, let's do gains. Although I'm going to cheat a little bit. I'm going to go for income first of all, because I think to understand gains, we need to understand income. So perhaps not very helpfully, income is the combination of revenues and gains. Okay. Yeah, but the trouble is though, again, these three words are all very similar, and depending on perhaps the discipline of the people in your businesses, they may use these words interchangeably, which doesn't help. Okay, but in the accounting rules that we follow, yeah, they do have different definitions. And I think it's helpful for us to understand that they are different things because then we don't get confused. So you voted for gain. So what is a gain? So this is something where we've got basically got money coming in, but it's not really very frequent. So if we sell an asset, for example, if we sell a car, well, okay, if you're Vospers, if you're a car dealership, then you're doing that all the time. Okay, so that would be a frequent thing, wouldn't it? But yeah, if you're not a car dealership, if you once in a while you sell a car and you sell it for more than its cost, then that would be shown as a gain. And in a set of accounts, we want to show revenue and gains differently because whoever's looking at the accounts thinks they need to understand, yeah, is this happening a lot or is this just occasional? Okay, so a gain is something that is occasional. Okay. Now, 33% voted for revenue, but might be able to work out what revenue is now. So revenue is defined as the income that's on its day-to-day activities. Yeah, so our day-to-day sales, yeah, that's what revenue is. Okay, but collectively that's income, and they are typically shown in different places in a set of accounts. Okay. Now I'm just going to jump and have a look at the Devon Chamber accounts. Okay, let's sort of see some of this in practice. Now, because of the size of the chamber, they don't actually show any of their income or gains. Okay, so it's a legal requirement for companies to publish their accounts, but the government appreciates that this is a bit of a pain in the bum to do that, and it's an administrative burden to produce these accounts and put them on Companies House for everybody to see. So if you're a small business, then you are exempt from having a full set of accounts. So yeah, with the chamber being too small for this purpose, they don't show any income, they don't show any gains at all. So I can't show you that. Okay, but I thought it might be just as a comparison. I've also got the London Chamber of Accounts here as well to just to give us a feel for this. So let me just go and jump to their accounts. So they've got a massive set of accounts. Okay, so I'm just let's go find the right page for us. Okay, so do you see in theirs? Okay, they are big. And they're showing their income and expenditure accounts. They've not called it profit and loss, they've called it income and expenditure. And yeah, they have shown, there is their income, but they've broken it down. Yeah, they've broken it into what income do we get from subscriptions? Yeah, as all of us pay subscriptions to the Devon Chamber, but they're also providing services like organising events that Claire was talking about at the beginning. And they're also recognizing that some of the money they have, they're making investments. But look, they've talked about that as a gain because they're not selling their investments on a day-to-day basis. That's occasional. So we can see now, we can understand that, okay, look, last time they actually made a loss. Yeah, last year they made a loss on selling some of those investments. Well, that's not brilliant, is it? But the fact that they've said that it's a gain or a loss, it means that they're not doing it on a day-to-day basis. It's like a one-off. Okay. Okay, so yeah, that's also hopefully putting a little bit into context what we mean by gain and revenue. Okay, so let's move on now to the idea of a balance sheet. So yeah, so let's vote on what you'd like me to explain for this one, please. By the way, again, please do ask questions in the chat if you have any. Okay, but by far the biggest winner here then is explaining what non-current is. Okay. Okay, so in the accounts, we classify all the stuff that we own and all the stuff that we owe to other people as either non-current or current. And this all relates to when do we think the cash will move. And I'm sort of simplifying this a little bit. But yeah, so for the assets, the stuff that we own, we'd expect cash to be coming to us. We'd expect to be earning money from those assets. Whereas for all those liabilities, what we owe, yeah, we'd expect to be paying out cash to other people because we owe them money. So we said, didn't we, that the accruals concept says that we don't really care when the cash flows, but it's sort of interesting, isn't it? Yeah. So for something that is non-current, that tells us that we will get the benefit of whatever we own for a period that's more than 1 year. Now, we don't show it any more detail than that. It's either, yeah, okay, so yeah, we can work out what current means. So current means that we're going to get the benefit within a year. So yeah, we're just going to show all of the stuff that we own and all of the stuff that we owe split between Will we pay for this next year, or will we pay for it in more than a year's time? So if you have a mortgage, for example, and thankfully, because I'm old enough now, I've only got 12 years on my mortgage to go. So that would be shown as a non-current liability because I owe money on my mortgage, but I owe more than 1 year. Oh, but having said that, though, I'm actually paying my mortgage every month, aren't I? So actually, some of the mortgage I'm going to be paying, I'm going to be paying in the next 12 months. So when we have something that we owe to people, we need to split it between how much of that total loan am I going to pay in 1 year's time and how much of that total loan I'm going to pay in more than 1 year's time. So it would be split between current and non-current. Yeah. So for any of you, when your accounting colleagues are asking about various contracts that you may have, again, they may be interested in, well, how long is this contract? What is the pattern of how we're going to receive the money for it? Okay. If you enter into any leases, for example, if you have some sort of 5-year lease, we just need to recognize that some of that lease needs to be shown as a liability for less than a year. That'll be a current, but the rest of it would be shown for more than a year as non-current. Okay. And similarly, now depending on what terms you have with your customers, some of them may be paying things to you in the long term. I mean, hopefully not. Hopefully they pay in 30 days. I wish. But that could also be a factor as well, that we may have some things that are shown as non-current. So again, let's have a look at the chamber accounts to see how this works. So I'm just going to go to the Devon Chamber. So yeah, they do publish their balance sheet. So there we go. And notice again, there's a bit of change in terminology because, well, that's allowed. We don't have to follow any particular words here. So we've got current assets. So what the chamber is saying, so notice the date as well. So this is not necessarily the most recent set here, that every business has plenty of time to prepare their accounts. So this is the most recent published set. But yeah, the chamber was saying that at the end of March 2024, they were expecting £687,000 to be coming in to the organisation in the following 12 months. Okay. And that's the current. Now, it doesn't say non-current, but that's what we've got here. So we've got the fixed assets. But yeah, that's what we mean by non-current. Okay, so you've got those fixed assets. So, and these are tangible assets. So they could be things like computers, cars, furniture, perhaps. Okay, so it's saying that we've got these physical things that we own. They are going to generate some sort of benefit for us because we're going to be using them in our organization. And yeah, we're expecting some benefit to come in. But for these assets, imagine you've got a computer. Can you really work out how much cash that's going to generate for us in the future? So for these things, so we've got things like a debtor, that's where your customers owe us money. So yeah, that is like a cash figure. Yeah, and the investments, so yeah, that's a cash figure as well. Well, the third one, that is cash. So that's going to be our cash income. Yeah, these are all sort of expected cash coming in. But for this, because we can't really work out how much income we're going to get from using a computer, this is actually what the cost of those assets was. Remember that idea, the accruals concept? We had the cost of buying the computer or the car on day one, and we're going to spread that cost over the life of the asset. So yeah, that 2,500 is not showing the income we're going to be getting, it's going to be showing the cost of that asset. Okay, so we're just spreading the cost out over its life. Okay, so again, that's a bit confusing, isn't it? That when we're comparing these two numbers, they're all shown as assets. Yeah, we've got the fixed assets and the current assets, but the way we're measuring those assets is quite different. And yeah, that can be quite confusing. Okay, so in the accounting rules, there are four different ways of trying to measure the value of something, and they are very, very different. Again, I don't have time today to go into the detail of that, but yeah, just sort of letting you know that we're measuring that in quite a different way. Now, notice, yeah, we're trying to tell the story behind these accounts, aren't we? So notice that there are some notes. It says, look, note 3. So that's where we can find a little bit more information, because that number, this 2539, that number by itself doesn't really tell us very much, does it? Okay, but if we scroll down and have a look at note 3, we might get a little bit more information. Okay, so yeah, this is where we have some detail. So that number doesn't include any computers. It doesn't include any cars. Yeah, that number includes fixtures and fittings. So I'm guessing all the blurred things we can see behind Claire there, that's and I guess the desk that you're leaning your elbow on, yeah, so that's included in that number. Okay, so yeah, we got those fixtures and fittings. And yeah, for many organizations, they would have multiple rows. So they might have some buildings. So again, there's no buildings mentioned here. So I'm just guessing that the chamber must be renting out their building rather than owning it. Yeah, so we might have vehicles. Yeah, we might have machinery depending on the nature of the business. And yeah, we'd have a column for each showing in a little bit more detail what's included in that number. Okay. Now we do have some more terminology here, depreciation, but we'll come to that a little bit later. Okay. Okay, so yeah, so there we are. That's the idea of what non-current means. Yeah, it's just we're recognizing that it's going to take more than a year for us to receive the cash or to pay the cash. Okay. And I'm guessing for when you're doing things like budgets and so on, you are thinking that far ahead. Yeah, and so yeah, we're trying to do the same here for people to understand what's going on. Now, I'm just going to delete everything that's on the screen at the moment. Now, why do we care? Why does the government say we need to put these accounts on the Companies House website? And why do we need to show between current and non-current? Well, the idea is because companies have limited liability, so whoever owns the organization, typically they can't be sued. The company can be sued, but the owners can't. Okay, and for the chamber, there aren't any particular owners anyway. So if you wanted to trade with the chamber, you'd want to know, am I going to get paid? So when you look at their balance sheet and you can see, am I going to get paid? Well, yeah, they're telling us they had £147,000 in the bank last year. That gives me a sort of a nice feeling that I might get paid. Okay. Whereas if that was a small number, but they had a really big number here in their non-current assets, then I might be thinking, well, yes, this is quite a big organization. They've got, I know, £1 million worth of non-current assets, but that may take 20 years before they actually get the cash. So will I get paid? Is it likely that Claire's going to sell her desk so I can get my invoice paid? No. Okay. So yeah, that's the sort of issue. That's why it's important for us to understand what's non-current and what's current. Okay. Right. So let's move on then. Let's have a look at some more terminology for us. So again, this is more of our sort of balance sheet items for us to think about. So yeah, let me put a poll on the screen for you. So can you decide, please, which of these 5 would you like me to explain to you today? Thank you, Claire. Okay, so the one that's voted is amortization. That's the winner with 55% of the vote. Well, the good news is that amortization and depreciation are very similar. So again, the words are sort of interchangeable, really. So let's do both of them, okay? By the way, so let's do amortization first. So this is spreading the cost of an asset over its life. Okay, that's what amortization means. And well, that's also what depreciation means as well. The difference between the two of them is the cost of what sort of asset. Okay, so if it were a physical asset, like a car or a building, then we would depreciate a physical asset. But if it was a non-physical asset, if we couldn't touch it, if it were an intangible asset, then we would amortize that. But basically, they mean the same thing. And they can be used sort of interchangeably. So yeah, if we're just spreading something over time. Now, I've said cost here, but we could also spread income over time as well. Okay, so if you think about like like a mobile phone contract. Okay, so I've got a mobile phone contract, and as part of that contract, I got a phone, but also I've got a 2-year contract, which includes an unlimited number of minutes of talking. Well, I'm an accountant, I have no friends, so I don't do much of that. And I've got unlimited use of text messages, but I've got a certain amount of data I'm allowed to use each month. Okay, so the total amount of my contract could be, let's say, £240 over the 2 years. So that's £10 a month effectively. But we need to recognize that some of that relates to my phone, the device they give me on day one. So of the £240 that they will get from me over the 2 years, they need to recognize some of that right away as soon as they give me the phone. And then the rest of it need to be amortized over the 2 years. Okay, so yes, spreading the income over the duration of the contract, that would be called amortization. Okay. And then in terms of depreciation, so yeah, that's spreading the cost of the asset. So again, let's have a look at the chamber accounts. And yeah, if we're going to have a look at note 3 here. Okay, so we don't have any intangible assets. Yeah, we only have tangible ones. But yeah, we've got that word depreciation there. Now, we often talk about depreciation when we buy a car, don't we? We say, oh, I buy a car, but it depreciates as soon as it leaves the forecourt. Okay, well, yeah, that's the word that we might use in everyday language, but that's not what we mean in accounting terms. Okay, so depreciation is not, okay, this is not equal to a fall in value. And that's what lots of people talk about. Yeah, my car is depreciated, it's gone down in value. Okay, but yeah, in accounting terms, that's not what it means. Okay, that is the result of depreciation, but depreciation does not mean a fall in value. So yeah, so depreciation is spreading the cost over time. So what happened here then for the chamber, they spent, I don't know how many years ago, £20,000 on buying furniture and fittings and so on. And they are saying that perhaps, okay, well, I know this may last for 8 years, let's say. So if we take the 20,235 and divide by 8, so that's going to be 2,529 per year. Okay, so the depreciation is how much of the cost we're going to recognize per year. In fact, no, I can see they've given us the cost for this year, haven't they? So I could probably work out the life of their assets. Okay, so yeah, it looks, yeah, based on that number, it looks like, I know, that they assume that the assets will last somewhere between 5 and 6 years. Okay, so that's what depreciation is. We're simply spreading that initial cost over the life of the asset. And by doing that, it does, over time, reduce the value of the asset in the accounts. So we paid the 20,000 for them originally. Now in the accounts, they're shown as 2,500. Okay, so that's the number that we're saying they're worth. That's the remaining cost of those fixtures and fittings that are in the accounts. Now that's not necessarily their value though. Yeah, so if we went to the chamber and had a look around their offices and we think, okay, yeah, the stuff's like 4 years old. Yeah, how much could we sell this for on eBay or Marketplace? I don't know, probably not a lot. Would we even bother selling it? We'd probably just throw it away. Claire shaking your head. Yeah, would we just throw it away? So it could be that the real value of those fixtures and fittings might be zero. Okay, but the fact that Claire is still using the furniture because her computer's sitting on it, it means we still are getting some value from it. Yeah, so Claire is organizing events. She would be unhappy to organize events with her computer just sitting on her legs. So she's using the computer, or using the furniture. We're getting benefit from the future. So yeah, we're still showing some cost in the accounts, even though it may have zero value from a selling point of view. But yeah, there's still some benefit from that furniture, so we've still got some cost. Okay. So yeah, in terms of those, non-current tangible assets, yeah, we're just showing that we had this original cost, we've been depreciating it, but yeah, there's still some value there. Okay. Now, I'm going to imagine that unless the chamber buys some more assets this year, that when they do their 2025 accounts, this might actually become zero. Because if their depreciation expense was 3,500 last year and they've only got 2,500 left, I can imagine that that may go down to zero. Okay, but that doesn't mean that there's still zero value. Okay, there's zero value in the accounts, but while that desk is there in front of Claire, it has value. She's still using the desk. She's still generating income for the chamber. Okay, so yeah, again, we need to recognize that there's an estimate involved. Yeah, I had an estimate of 8 years. It could be somewhere between 5 and 6 years, but how we calculate that depreciation is estimated. And it's quite unusual that an asset will fall apart when it comes to the end of its depreciable life. Okay, so yeah, again, we need to recognize that there's lots of judgment involved in accounts. It's not necessarily based on fact. Okay. Okay, so yeah, that's what amortization means. So if there was an intangible asset, okay, let's have a quick look at the London Chamber. I wonder if they have any intangible assets. Let's have a quick look. So yes, look, they've got some intangible assets in note 7. So let's get an idea of what they may be amortizing. Let me just quickly scroll down to note 7. Well, they've got loads of notes, haven't they? Oh, have I gone too far? There we are. Note 7, intangible. Okay, yeah, so they've included software as their intangible asset because we can touch our computers, can't we? That's tangible, but the software, we can't touch the software. So yeah, they've treated that as an intangible asset. Okay, and they're slowly recognizing the cost of that software over some period. Yeah, we can't see what period they have here, but yeah, they're recognizing. In fact, if I just scroll up a little bit, we could find out. Yes, the very first note is all their policies. So let's see if I can find their. There we are. So look, so they spread their software using 7%. Okay, so that's over. So is that 12 years, 14 years? Okay, so they spread their software over 14 years. Oh, well, I wish we only got updates every 14 years. That would make my life easier. Okay. Right, I've got 12 minutes left. Okay, so here's some more terminology then. So again, more things that you might see in the balance sheet. So again, just providing a poll for you now. Yeah, so which of these would you like me to explain, please? And please feel free to ask questions. No one asked me anything so far. Hopefully I'm not so scary that you don't want to ask me a question. Okay, so we got a clear winner here. People have gone for prepayment. Okay, prepayment. Okay, so in the Devon chamber there isn't any prepayments. Let's have a quick look at the London chamber. Do they have any prepayments? No, they've not shown any either. So, okay, so I can't show you an example of these. Okay, so what do we mean by a prepayment then? Let's put this back on the screen. There we go. So that's when we pay for something in advance. Okay, so this is an example of an asset. Okay, a prepayment is an example of an asset. It's sort of like something that we own. Okay, so yeah, if I talk about my house, so yeah, my house is something that I own, although, well, I've got another 12 years to pay for it though. And if we bought some stock, that's something that we own. Okay, but for this prepayment, we don't really own it, but there will be some future benefit coming from it. So for example, with insurance, yeah, so, when we have our car insurance, for example, we could pay monthly for our car insurance, but you can pay for your car insurance, up front, can't you? You pay for the full year. Okay, so remember the idea of that accruals concept. We should recognize the expense and match it with the benefit. So let's suppose that today, at the beginning of July, I pay for the next year for my car insurance. But at the end of July, I've had the benefit of 1 month of car insurance. And therefore, at the end of the July, I still have another 11 months of car insurance to go. Okay? So the prepayment would recognize the 11 months that I've paid in advance for that car insurance. So I'm recognizing that I've got the benefit of another 11 months to go. Okay. Now, again, this is quite useful. Again, remember I said, why are we publishing accounts? It's to help people decide, should I trade with these people? Am I going to get paid? So again, we would typically show these prepayments separately because if you wanted to trade with the chamber and you're thinking, am I going to get paid? Well, could we get 11 months of car insurance back? Could we use that to pay our suppliers? Well, we can't we? I know. I suppose, yeah, I think, aren't you allowed to get a rebate from your insurance if you sell your car early? So I think we could get some money back, couldn't we? After they've deducted all of their fees and so on. But yeah, so we just need to be aware that for some of these prepayments, we may or may not be able to get some cash back. Okay, so again, it's a type of asset because we're going to get some benefit, some service in the future for something. Okay. Okay. Right, so let's have a look at the next bit. I've been touching on the Devon Chamber accounts, but remember that this was the next objective, and I've only got 8 minutes left. Oh no. So can we tell the story behind the chamber? And remember I said if you wanted to come along to a longer course, we could actually look at your accounts to help us understand all of that. Okay, so let's have a look at the that's the London Chamber. Let's go to the Devon Chamber. Okay, so let's have a look at their balance sheet. Remember they're exempt from publishing profit and loss account, but yeah, here is their balance sheet. So yeah, we've looked a little bit of this, haven't we? We've looked at their fixed assets. So this is where we get the long-term benefits, and we looked at their current assets, and then we've got some other things here as well. So we've got some creditors. So this is where we owe money to other people, but notice, yeah, that's a current issue because we need to pay that in the next 12 months. And if I were looking at this and thinking, okay, I want to trade with the chamber, will I get paid? Well, looking at these two numbers together, and it's not a coincidence they're published next to each other. So I can see that 687,000. That's how much cash I'm expecting the chamber to receive in the next 12 months. And the 344,000, that's how much I'm expecting them to pay out in the next 12 months. So the difference between the two numbers is the 342,000. So am I going to get paid by them? Well, yeah, they're going to have a spare 342,000. So I think they will be okay to pay that. Yeah, I'm pretty comfortable that I could trade with the chamber and not have any worries about them at all. Okay. And then looking at, they've got these creditors, amounts falling due within 1 year. Again, they don't seem to have any amounts falling due after 1 year. They don't have any non-current debt. So again, that makes me feel quite nice as well. They don't have any big loans. So we can see then that our net assets, so that's all the things that we own, take away all the things that we owe, yeah, that is our 344,000. Now, there are no owners for the chamber. Okay, so that doesn't belong to anybody really. So yeah, that's included in their reserves. I had that word equity earlier, so yeah, we would talk about that as being equity. So yeah, this is their reserve. So we can see that that's the sort of the money they've put aside for a rainy day. So if they had any problems in the future, they could call upon those reserves to help them out. Okay, so that's what we mean by that. Now, if we looked at the London chamber, again, theirs is much more complicated. So if you look at their balance sheet, so yeah, so they have all of those long-term assets. So they're expecting 10 million worth of benefit in the future. They've got their current assets, so there's 17 million pounds worth that they're expecting cash to arrive in the next 12 months. They also have some current liabilities, almost 5 million they're expecting to pay out in the next 12 months. Oh, but look, they also have a long-term liability as well. They've got a pension liability. Okay, so they've agreed that for some of their employees, they will pay them some sort of pension when they retire, and they need to have a liability to show that they need to do that. Okay, but yeah, overall, yeah, they've got 19 million pounds worth of reserves available for a rainy day in the future.
Just a quick reminder, that's not our accounts.
Yeah. So here's the Devon chamber. Yeah, but even so, blimey, Claire, having 344,000 set aside for a rainy day, that's nothing to be worried about there. Yeah, so I'd be very happy to trade with the chamber. It's all looking very, very healthy there. Yeah. If anything, and I'm not allowed to give financial planning advice to individuals, but some of that spare cash could be invested to earn a bit more money. Yeah, that might be quite nice. Yeah, but yeah, that in no way, theoretically, yeah, that is in no way financial advice. Quickly put that disclaimer in. And then, if we went into the notes, let me just scroll down to the notes because they did give extra information for us to sort of tell the story behind them. We can see, look at this, number of employees. So that's got nothing to do with numbers in terms of cash. Yeah, that is a number of employees. And remember, part of what we wanted to talk about is, where do your numbers appear? So yeah, the law requires that companies disclose how many people they employ. So yeah, when the accounting department are nagging you for information and you think, oh, why do they want this? It's because there may be just some bit of legislation somewhere that tells them that they need to include some number in the accounts. It's just a legal requirement. And it may be a bit tedious to have to provide this information to your finance colleagues, but it's because they're required to do that. Okay. And then we've got some other breakdown as well. So yeah, these are the amounts of money owed by customers. Oh, look there, we have found some prepayments after all. So they weren't disclosed on the face of the balance sheet, but yeah, there were £13,000 of payments made in advance to other people. So that's the advantage of these notes. Okay, so you may not be able to tell the story of the business by looking just at the first page, but when you dig a bit deeper into the notes, that's when we can get a little bit more information. Okay, and then we can see that, oh yeah, there are some investments. So that's pretty cool as well, because the chamber does have some spare cash. Okay. And then here's like a breakdown of all the money we owe to other people. Now, in particular, what we're interested in is, look, there's some tax ones there, because remember why we're looking at this. We want to understand, will we get paid if we bill them? So yeah, if we invoice the chamber, our invoice would appear in that number. But we know what it's like. Yeah, we know the government will take their cash before we pay our suppliers. So it's just useful to know how big the debt is to the government, because we know that they will have dibs on this. They're going to take the cash more quickly, aren't they? Okay. Now, the third thing I want to talk about, oh, I've only got 1 minute left, sorry, is where do our numbers appear? Well, to be honest, there's a very simple answer for this. Theoretically, it depends what part of the business you're in. Now, in a profit and loss account, we would have a little bit more detail about, there are certain types of costs that we would show: production costs, we would show distribution costs, we would show different types of costs in a profit and loss account. Again, we don't have one in the chamber, but it just depends on where your business is. So yeah, your salary may appear in lots of different places depending on how we present the profit and loss account. Yeah, the activity. So yeah, I saw someone, they had the pricing email. So I'm guessing that if you're involved in working out pricing, then your costs might be included in the distribution and selling costs in the profit and loss account. But if you are a salesperson, then yeah, your cost may be involved in there as well. But if you're involved in actually making stuff, production, then your cost may be included in cost of sales. So it really depends on what your job is. Okay, so there's no easy answer for that. Again, if we had more time, I could talk to each of you individually. You could work out where your costs are. But yeah, it just depends. Anyway, look, I've run out of time there. I'm not going to run away now. I've got time for questions if anybody wants to ask questions. But if you need to run away, you're welcome to do that as well. Okay.
Thank you, Ross. That was super helpful, and a really good, easy to understand explanation. So very, very grateful on behalf of me. Looks like from some of the comments that other people are saying similar, but did anybody have any questions? May not want to ask them on the call, of course. Did we maybe want to stop the recording, Ross, and then see if anyone wants to ask any questions without the recording?
Yes, of course. There we go.